What's up, everyone? I hope you had a great trading week so far. I'm just making this quick video so I can break down this trade right here that I caught from yesterday to today on NAS100, which ended up being a 9.5 risk-reward ratio. And as you can see, the market ended up going even higher, so I could have potentially even caught a 1 to 11 risk-reward ratio on this trade. I'm going to tell you exactly why I got into the market here, how I found this trade, and how you can find trades like this easily. Only a small percentage of my viewers are actually subscribed to the channel, and it would be a great help if you took the time to just click subscribe real quick. It's free, and you can always change your mind later. Anyways, enjoy the video. First thing is, I'm going to go to the 15-minute because I analyzed and entered this trade on the 15-minute time frame on NAS100. I am on the O1, the CFD NAS100 on TradingView. It's just my preferred one. The price is the closest to my actual broker's price. And the analysis on this was actually super simple. If you're just looking at this, if I zoom out a little bit, you can clearly see that we just recently, about a week ago, had an extremely steep downtrend over the course of 2 days. And after that, a lot of people, what they'll do is they'll try to predict the end of that downwards move, and they'll buy. Let me get a proper arrow here. They'll buy like right here and they'll get stopped out. And they'll buy like right here and they'll get stopped out. And maybe they even buy again down here and don't get stopped out, but they have to wait for 4 days, if you look at this here, to actually get a trade going. Not really optimal. How I found this trade was not taking a trade here, not taking a trade here, and letting the market lose momentum. Momentum is something that I've only really recently got into in analyzing and deciding whether or not I want to take a trade. And it's something that has just completely catapulted my win rate because I kept trying to find candle patterns like this little hammer here, or the doji here, whatever you want to call it, or the doji down here as reversals, or the doji here as signs that the market was going to turn around. And that was the wrong damn thing to do because the market still had momentum on its side, in its favor. Losing momentum is a crucial part of a market actually turning around. Obviously, if you have like 100 people pushing a pull door closed, the one guy that wants to pull it open is going to have a very hard time pulling the door open. If you wait for all those people, all this energy right here, all of this area here, this is just market energy, okay? If you wait for all of that energy to dissipate in the form of something like this, where you have a triangle pattern forming, and the market, as you can see, is getting tighter and tighter with how it's ranging, that's market energy dissipating. That is a momentum loss, and that is exactly what you need for a clean trade like this before you can enter. If you enter here, maybe you get lucky. If you enter here, maybe you get lucky. If you enter here, maybe you get lucky. But what about all the times where you don't? What about the times where this is a stop loss and this is a stop loss, and maybe over here you trail your stop loss and then the market goes back? What about all those times? Those times, those things, those problems can be avoided by letting the market lose momentum. If you look at this on a bit of a zoomed out scale, if I just drag this back here, what we have here is a very clear pennant forming, right? We have our downwards move and then a descending triangle here. And it's very obvious if you learn the patterns a little bit. You just need to zoom out. If you go to like the 15-minute or the 30-minute on NAS, you'll be able to see these things super easily. You can even see them very easily on the 5-minute, as you can see here. But the wicks might be a little annoying for that on the 5-minute. So again, I suggest maybe the 15-minute, even the 30-minute to do your analysis. What happened then is over here, I was fairly sure this was going to be the breakout. Now, the reason I thought this was going to be the breakout is kind of market experience. I can't exactly tell you why, but I knew, well, I didn't know, but I expected the market to go upwards here because we had a big push to the upside here in the last half hour before the New York market opened. And because of that, I was confident enough to enter early. Now, entering early is very aggressive. I don't suggest that you do it, but it worked out in my case. And we had an immediate push to the upside for the first half hour, which was fantastic. And then what we had is, if you're familiar with, let's say, ICT stuff, or just the market in general, ICT didn't come up with any of this shit, but if you're familiar with what happened here, is we had this massive push to the upside, and if I zoom in, this black box here, we have a fair value gap, and the price came back into the fair value gap and continued to push to the upside. This right here gave me the confidence to continue to hold the trade. I did not trail my stop loss. However, I could have trailed to below the moving average if I wanted to. Or after this pattern here was completed, once it pushed to the upside over here, I could have trailed it to below the candles here. Fairly simple. But again, the fair value gap here gave me the confidence to continue to hold the trade. I want to quickly go over how I managed the trade afterwards, like once I got into it here, which is fairly simple. Usually if I do trail my stop loss, which again I didn't in this case, but if I do, I will trail it via market structure, which if I put a line right here, let's say this down here obviously is my stop loss. This is the first bit of market structure that I see. I'm just going to switch to that just so I can show it a little bit better. This is the first piece of market structure here. And what we have here is, again, a rejection of a fair value gap on the 15-minute time frame. Once these candles up here close, as you can see, this is the previous close, right? So we have something like right here. And then we have this next candle that goes slightly above. The wick is up here, right? So once this candle up here, this one, closes above the wick of this one, we have a confirmed new high. Once we have this confirmed new high, I can then take my stop loss from down here, I can move it to here. So I'll go ahead and do that. I will trail my stop. Oh, nope, that's a mistake. I'll trail my stop loss from there to just below right there. And then we have a new thing right here. I'm going to quickly, where is it? Grab myself a circle here, just so I can drag this around a little bit easier. Once we have this here, right, this is a new low. This new low is then broken when this candle right here, that one, this big white candle here, closes right here above the previous high. This means we have another confirmed new high. Now I take my trailing stop loss and put it right here. If I were to trail my stop loss. Again, in this trade, I did not. But if I would have, this is what I would have done. Then we have another higher low, and this candle right here with the big wick on top closed right here past the high. So this is another confirmed new high. So now my trailing stop loss would go right here. Then we have another new low right here and a candle right here closing past it. You kind of get the concept at this point. This is basically just what you do. And now I'm going to quickly analyze or explain why I targeted this up here. And then that's the end of this video. It's literally just this simple of a trade. The reason I targeted up here is, if you look over here, we actually have price touching this area quite a couple times. When I target my, or when I set my targets and stop losses, I want to put my stop loss in a place where it's unlikely to get hit again, where the market will tell me that my prediction was wrong, okay? And I want my target to go somewhere where the market is very likely to go in the future. So I could have targeted up here, and in this case, again, it would work out. If I drag this up to here, I could have gotten, an 11.5 risk-to-reward ratio. This right here only has one magnet point. This down here has 4 magnet points. And what I mean with a magnet point is this right here. We have, oh, come on, right here, right here, right here, and right here. If I want to target up here, it only has a magnet point right here. 1, maybe 2. If I target this down here, right? If I target this area here, we have a touch here, a touch here, a touch here, and a touch here. This means that the price is much more likely to go up to here and bounce off. And it's exactly what it did here. We zoom in on this. It touched this exact area and then bounced off. Now, luckily for us, it continued to break to the upside again. But this could have been just the start of a move back to the downside, which wouldn't have been that good. That's why I targeted up here for a 9.5 risk reward ratio instead of going for like a 10 or an 11 or a 12 or whatever else I could have targeted. Because my target, like I said, should be somewhere where the price is very likely to go again, right? And this is an area with a strong magnet force, where multiple touches were made in the past. And down here, this stop loss is in an area where we just had a major rejection, right? If I just zoom in on that a little bit, we just had a major rejection here. And if it continues to go down from here, it's likely we'll have a bounce off the bottom here and then a breakout. So I could have just re-entered there. But again, this is in a place where the market is unlikely to go again. So if it does get hit, it tells me that I was wrong. And to take profit is somewhere where the market is likely to go again. Again, somewhere where it's touched multiple times in the past. Because that'll tell me that my prediction was right. My target should be easily reachable and my stop loss difficult to reach. That's the best way to trade. Have a target where the market is likely to go and a stop loss where the market is unlikely to go, and then have a strategy in between that to tell you those trades, to give you those trades. My strategy in this case was very simple market patterns, again, just like a flag pattern or a pennant pattern, whatever you want to call it. I don't actually know the words. I just know there's a triangle and there's a trade. You don't need to know all the words. I don't, and I'm 4 years into trading now. You don't need to know all the words, god damn it. It's too complicated, it's too complex. It's unnecessary. Just learn the concepts. You don't need to know the words or any of that. It doesn't matter. Learn whatever you want. It's simple. Just super simple trade. I just wanted to break this down because this is one of the biggest trades that I've had in quite a while. And I'm honestly just impressed with how simple it is. Just how difficult I used to think trading was. And then stuff like this happens. Just almost a 1 to 10. So simply, with just some lines and just knowing how the market works. I just wanted to break that down for you guys to hopefully get you to a point where you can also take these trades. They are rare. They're not going to happen all the time. But when they do happen, they're fantastic. And they're super, super useful to just boost your account. And they're going to make you a lot of money if you learn to trade them properly. And I hope that this breakdown helps you. And I hope you have a great rest of your trading week.